Hey, everybody. Good evening. We're going to get started a couple minutes after the hour. Thanks for joining us tonight. People are just starting to log on. We always like to give people a few minutes to finish maybe a late dinner, or they might even be getting out of an early work if some of our people on the West Coast. Looking forward to tonight. This is our masterclass, which really talks about not only my real estate journey, but several other real estate journeys and how this new construction turnkey model actually came about, some of the principles we've learned over the last 25 years, kind of our strategy for helping our clients make money in real estate investing and rental property without the headaches, and some of the ways that we do it in our focuses for the next year. So we're going to wait a couple of minutes and then we'll get started. So we'll get started about 3 after. Jennifer, one of our property counselors who's been with us, 14 years now, worked with us for a long time and has helped build a lot of portfolios, and an investor herself. She'll be on moderating with me tonight along with Jaden. So if you have any questions, go ahead in the question box or chat box, let us know so that we can answer them at the end. If something's real important, I'll stop and go through. But we do like to take time to answer questions at the end. So don't be shy. Also, we like to know where our farthest people are coming in from. I think we had someone last month from Singapore. So let us know where you're coming in from. We always like to see, are you coming in from our California contingency, New York, Miami, Orlando, Texas, Chicago? Let us know where you're coming in from. Jen might already be working with you, but some of our team will be on as well. But great to have you here tonight. Again, we'll get started in about another minute or so, give people, a little time to actually get on. So that's when we'll get started. So give us about another minute, give people time to get on. All right. Another minute. And again, we'll try to keep this for under an hour, but we want to make sure that we get in some good content and education, things that I thought were important, a little bit about, again, the journey. And again, we'll have time for Q&A at the end. So please, don't be shy to ask questions. There are no bad questions. This is live for a reason, because we like to interact with the people getting on. You might have been with us for years. You might have just gotten involved with our investor community. But either way, please make sure you ask questions. So, all right, with it being 3 after, I want to welcome you tonight to our Southern Impression Homes Masterclass that we've designed to help really onboard the experience and the education where we've come from. A couple things, just one thing, this is only for educational purposes on real estate investing. I'm not giving tax advice or legal advice in any way. And my journey started many years ago, probably about 27 years ago, when I was handed these 2 books. That started my journey, Rich Dad, Poor Dad, and 7 Habits, to becoming an entrepreneur. And I didn't even know what the word meant, but I remember someone who gave me these books, a friend of my parents, said, you should try to get into buying and acquiring income-producing assets, real estate. And I said, I don't even know what that means. But these 2 books started that journey. And I became, after looking at many different business adventures, opportunities, I found real estate kept coming back to me. I like the tangibility. I grew up near Wall Street. I had no interest in that life, but real estate made sense. The tangibility, the levers you could pull. And in my early 20s, I actually signed up for an investor class, a real estate investor class, for $5,000. My family and my friends thought we were crazy. But that class, what I learned in it and the things that I applied and started to put to work slowly but surely, created my wealth for me. And it was something that, again, was a big risk at the time, but I was willing to take that risk because that young, impressionable guy in his early 20s, I had a simple goal. I had seen with real estate that you could build wealth and also have passive income, which gave you active freedom. See, I wanted, my goal was, if I could get the real estate in place, then I could get to the good stuff, the important things, or what I considered the good stuff and the important things in my life. And that's what real estate was able to create for me. But it started slow. This was my first deal that I did based off of that first class that I took. I bought this property in 1999 for $152,000. And it became kind of my piggy bank to start to leverage off of to build the rest of my portfolio. I did sell it in 2004 when I was moving to Florida. for about 4 times what I bought it. Today, it's worth about 865. But it served its purpose for me, moving that in 1031 into Florida properties. But this is where it all started. And again, rehabbing properties, you can see that I wasn't very good at rehabbing. In fact, I've done almost 2,000 rehabs in my life, and I only did the first two with me actually in the trenches. I remember my contractor friend said, "You got more paint on yourself than you did on the walls. You're not made for doing the actual work. You better figure out how to be a better organizer than rehabber yourself." But that first one again gave me some really good clarity that I've been able to reflect on, over the last 25 years. And real estate investing is about time in the market, not timing the market so much, but the more time I've spent in the market, in the real estate markets, the more my luck has grown, the more my wealth has grown. And, I always had that example from my family. When I look back, the key to wealth is long-term buy and hold. And when you hold a property long term, the right type of property, buy and hold, it is one of the main proven ways to create wealth in your life. And for my parents who did not earn a lot of money, did not come from a lot of money, this was their retirement, a home in North Jersey, where they bought it for 49,000 in the early 70s. And then about 30 years later, they sold it for almost 600,000. This provided their retirement. And that was just one property. And then here, going back an even generation further, this is my great grandfather's house in Northern Ireland, where he built it for, I think, about $1,200. Now my second cousin still owns it. It's been in the family, I think, 142 years. And obviously, they're sitting pretty well in this property. And I thought that was just two examples of properties. What if it could be done more to hold more properties for the long term? And that was my goal. I started in California. This is my first business right here, cutting the ribbon with the mayor, where I would fix up old houses and rent them, either work with investors or keep them for myself. And it created wealth for me. But although it created wealth, it bankrupted my time. And that's not what I would recommend. In fact, a lot of you that we're working with, you're looking to buy back your time. You're not looking to bankrupt more time or create a second or third job. So real estate investing, I found the way that I was doing, the type of properties, the abundance of rehab sounded exciting. It did create wealth, but my time was being bankrupt. But things all changed because I did take a pivot about a decade ago. And about a decade ago, I went into new construction, and new construction changed everything. And it's really the last 10 years, although I had good times along the way, it's the last 10 years that I've really been able to step into that, active freedom from the passive income. I'm very involved with my family. I have a beautiful wife, 5 children, aging from 3 to 21. So we have quite the gamut. We love adventuring together. We have no shortage of it. Spending a lot of time in our home in Costa Rica over the last few years, getting to know our roots in Ireland again, renewing our vows in Ireland with our whole family, and going back every summer. We've really tried to encapsulate that quality of life for our family that I couldn't do. My real estate, again, for my father was one of the best things. My real estate paid for the kidney donation that I was able to donate a kidney to my father. Probably one of the best things I've ever done. Again, if I had not gotten into real estate investing, I would have never had the money or the freedom to be able to do this with my father. One of the best things that I've ever done. And I talk a lot about how did the wealth actually get built, step by step. What are the wrong things I did? What are the right things I did in this book? It's a USA Today best-selling book now. My wife and I wrote it along with my partner, Chris, our whole team, many of our investors. And it's all about our model today and the principles that it's been built around, and how it's helping over 1,000 investors achieve that passive income and active freedom through our new construction real estate. Another thing too, I was able to, with my real estate investing money, create a family book. And that went to a #1 Wall Street Journal bestseller. I would never have had the opportunity to write that book, had the connections or the capital resource to do this without my real estate investing. So I know the difference real estate investing has made for me. Again, getting my real estate in place has allowed me to get to the good stuff. And that's what we want for all of you. And your active freedom might look totally different than mine. I want to be in Ireland. I want to be in Costa Rica. I want to be surfing a few times a week, lots of time with my family. And so you might share some of those, sharing things with loved ones, upgrading your current health situation, pursuing old passions that you gave up years ago, traveling the world, with your family or friends. Quitting your job, that's a big one we hear about, that I have seen a lot of investors we've worked with phase out of their jobs because of getting real estate in place. Some investors we have bought planes to continue their hobby of flying. We'll talk about that a little tonight. And some people, including myself, I was able to retire my parents who never were able to earn much, but that was a big goal and something I've shared with a lot of our current success story investors. Chris and Carter, I met these guys about 15 years ago, and we were working on different rehab projects and such, but they were the catalyst of starting this new construction model. They had a property management company that managed my portfolio, and they said, hey, what would you think about building properties instead of fixing up old ones? And I thought that was a terrible idea. I was a rehabber. I didn't want to do new construction. I didn't even know really how it worked. But I'm really glad that they convinced me. We went in on those first group of properties together. Eventually, I merged my separate investment company with Southern Impression Homes because I saw the growth and the potential it could create, not only for myself and our team, but also, our many investors. And it's done just that. Our team is a team. It's not just real estate investing is a team sport. It's not a one-man show. Anyone that tells you differently. There are a lot of things that go into this. And I could never do what I do without a team. And I want to make that very clear. And our goal as a team is to have one of the best outlets for busy investors like yourself looking to get into real estate. Maybe you're experienced, but your own backyard doesn't supply. We want to be that channel for that, working only in new construction and feeding our message to people that want to follow the path that we followed in order to create wealth and passive income. Our old office in Jacksonville started at this, and now on the right, that's what we've grown into. We've gotten more capital, resource, and support. We've had a large Japanese company buy into us to support our effort and growth. It's a very exciting time for us, and not only for us, but that includes our investors, and we'll talk about some of that tonight. Our company was built by investors for investors. Any way you look at it, we went into the trenches for a good 15 years and understand what investors need, what they don't need. And so we felt that was really important for having the success that we've had. And we work with wealthy and ultra wealthy people to build successful rental portfolios for long-term wealth. That's our whole goal. That's what we do. That's how we create that passive income, long-term wealth, and active freedom for our people. And that's, and to break it down a little bit more, that's affordable new construction in affordable growth markets with low interest rate mortgage financing. You probably think, oh, you can't get that today. Not true with our in-house financing. We'll talk about that. And doing all these things with the low interest financing helps you ensure cash flow, even on new construction properties. This is our strategy, and we follow it very closely. And obviously, you got to have really good management in place, which we'll talk about as well. So what do? We have three goals. We want to build the property right for you. We want to finance the property right for you. And we want to manage the property right for you. Wherever you go, no matter what you do, these are three things you're going to have to figure out either on your own, or you can lean on someone who's been there, done that. And that's what we try to do for our investors. Property management is one of the key things to do. I'm sure, your property counselors, if you're not already assigned to a property counselor, make that your first goal. Get that done today. I wish that I had a property counselor 25 years ago when I started. This was such a key element to the success of our investors. A lot of you on here are probably thumbsing up what I'm saying right now, because this is your guideposts of how to invest, how our model works. So the first stage is always our property counselors. And then for the long term, it's our property management. So you got to have these things in place. That is the starting point to our business model. And within our business model is only three types of properties, really, and that's single family homes, duplexes, and quads. Now, this is all residential real estate because we want to get you that good residential financing. And these are the proven building blocks of wealth. Commercial real estate is great. I have friends who have made a lot of money in it, but the most proven model with the least amount of ups and downs is affordable, median priced, meaning it's priced near the median of your market or market you're investing in, these types of properties. The single family home is the absolute bedrock of the US economy. It always has been. And then duplexes and quads are just a close enough variation where you can still get those residential results, but with higher cash flow and leveraging into one loan to get more units. So we've built this in order to have this recipe for the best results. Now, where do we build these properties? We are very, very heavily invested in Florida right now. You'll look at this list, though, and you'll say, gosh, Jim, you're not in Miami, you're not in Orlando, and you're not in Tampa. No, we're not. We do some building projects there for some larger groups. But we, for our investor community, bought a lot of land in more up-and-coming areas where there was better affordability, still a lot of growth, and I'll go over that in a minute, but where you could get cash flow off the bat. You know, a lot of these places, Miami, Tampa, Orlando, especially through the last 5 years, you know, you might get some equity growth, absolutely, but we don't want you having negative cash flow to start. We want to have the best of all worlds. That's why we go to these markets here and have gotten the results we've gotten. Now, there are 5 factors. No matter where you go, please remember this. There are 5 factors that drive a real estate market. I want to make something clear. I don't depend on appreciation, but I do my best to get in its way. I do my best to get in the way of growth and appreciation. And there are 5 indicators that have been proven that help you get in the way of growth and the best results. And it's these 5 factors: economic growth, you know, jobs, population growth, super important. Is the population going up or going down in that area? Affordability. This is the word of the year. If some of you are on my State of the Union address at the beginning of this year, the A word is number 1. Affordable properties, right? In affordable growth markets, you want affordability. This is absolutely key for our business model. We don't go high end, but also we don't go to the super low end either. Again, that's where step 4, desirability, comes in. Desirability is not only, is the area nice? Is there something drawing to it? Are there healthy landlord laws for the areas that you're building and investing in? And also, would I want to walk down the street at 9 o'clock on a Friday night? That is a key of not only being affordable, but desirable. And along with that, healthy supply and demand, right? We don't want to go where there's an oversupply of houses and the population's depleting. We want to go where the municipalities are yelling, hey, we need more rental property, especially affordable rental property. Who's going to build it? So these are the 5 factors that we follow, and I recommend you follow with any decisions you make if you're going to invest in a certain real estate market. Now, currently, just to tell you a little bit about our company, we have almost $1 billion under asset management now. That produces about $56 million in annual recurring revenue for our investors. We've created almost $200 million in equity for our investors just in the last few years. We currently have over 1,000 active investors that we're working with. We've built over 9,000 units. We house over 10,000 residents currently, and this is an affordable workforce housing. We have over 120 people on our team, and that's growing by the week. And in order to start investing with us, it's a minimum investment of $80,000. Now, I want to be clear on this because some people get confused. We provide property ownership, direct property ownership, and this $80,000 minimum investment, this would get you into one of our single-family homes with your down payment, closing cost, and some estimated reserves that our property counselors like to see on the side for you to help build the portfolio the right way and as you're stretching yourself, but not overwhelming yourself. So in order to invest with us, you need to start to build that portfolio with about $80,000. We can get you started from there. If you're not at that point right now, don't get discouraged. I wasn't at this point 25 years ago, but you're able to work your way up to that, and our property counselors can talk to you about that. So we also have 5,000 lots in Florida right now, and we plan to build them all out. We feel Florida, and people that are a lot smarter than me feel Florida has an incredible growth pattern still, at least for the next 10 plus years. And I'll show you some graphs that show that, but we plan to build these out. So where a lot of builders are still looking for land, and land has a lot higher prices, we were able to buy a lot of land right at the beginning of the pandemic before prices jumped. So we have no shortage of lots and land that we're building out our recipe on right now. Now, this is an important graph right here. People say, well, how do the numbers work? Do they work with your new construction rentals? Well, let's take a look at a couple of options. If 5 years ago, you had invested $250,000 into the S&P 500, today you would have had about a little over a 10% annual return. That's a good return annually, absolutely. If you had invested in a real estate fund, let's say a good real estate fund that's buying real estate, borrowing money from you and paying you an interest rate, let's say it did well over the last 5 years and it hit 13.5%. That'd be a good return, very good return. That's good, that's solid. However, if you had invested $250,000 into our new construction turnkey rentals in Jacksonville, Florida, 5 years ago, your annual return would have been just under 70%. This is where the numbers don't lie. This is why I always encourage people, hey, invest in the S&P 500, invest in a REIT or a solid real estate fund. I do as well. But direct property ownership, owning my own rental property, has what's created the majority of my wealth. And I want to remind you, there's a reason why, the big guys come to us to raise capital from us, right? For this middle offer, the fund, like a real estate fund. Then they go out and buy property and they own the property, then pay us a high return. So they have to be able to make a really good return in order to pay us 13.5%. And you can see this is possible because we work with some of the bigger guys who get these type of returns. Now, this doesn't always happen, but these are the last 5 years of what we've seen if you invested $250,000 into our new construction rentals. So wealth, independence, security are not just the products of work. The one thing you got to remember, a paycheck can suddenly stop and you're trading hours for dollars. You have to make sure you're putting things on the side because you cannot work as quick as you can invest for the long term. It will catch up with you. So there's 3 types of investors too. This is really important to know. Now, the first level, if you're going to get into real estate investing, you can get into fix and flip. Fix up a house, flip it, sell it. That can be great. That's how I got started. But some of you might have no interest in that. You're not really looking for that. You already have a successful career, practice, business. You're not really looking for that. You're looking to plant longer seeds. Okay, well, that would be the next level, which I consider enhanced. That's when you're a do-it-yourself landlord. You're finding properties in a market on your own with your own realtor that you find. You're negotiating the deal by yourself. You're finding your title people, your insurance, your mortgage company, your property management, your own contractors. You're a do-it-yourself landlord. You might even be managing it on your own. And that could be a great way to start. That's how I started. However, again, like I talked about, this can help create wealth. But if you're already kind of low on time, this can completely bankrupt your time. When I was doing this full time, that's what happened to me. So people with successful careers or businesses already, that can be really hard, which is why the engaged level came about, the turnkey real estate 2.0. Now, turnkey real estate came about just after the '08 meltdown, where it was more for fixer-up properties. Hey, I'm in Jacksonville, Florida. There were people in California saying, can we hire you to find us, good deals, fix them up, get them tenant occupied and manage them for us? Sure. And we did lots of that. The 2.0 for us came after we did so many rehabs and we found that the older houses, and I'll talk about that, did not perform as good as new construction. So we only offer a turnkey solution, the property, the management, the tenants, the insurance, the mortgages on new construction property. And that's where we stick it now, the engaged level. I'm not working at the effective level anymore or the enhanced level, only at the engaged level for myself and our clients. Without your money working for you, you'll never stop working for money. And that's why we want to see people start to really, solidify themselves into some assets they can lean on, not necessarily right now, but definitely in the near future and definitely the distant future. So even if you're trapped and you have a good income, it's hard to build. It comes from setting a growing asset base in motion. You can focus on accumulation while still extracting cash as needed. Like I showed you, I was always pulling off that first property. And that's one of the beauties of real estate. So asset owners finish ahead. Remember that if you're not willing to actually own assets, it's very hard to achieve the wealth goals that most people have. And that's something that Tom talked about. So Tom is now a friend of mine, has worked with us for years. He came to us many years ago. We had a lot in common with some of our values, family stories. His beautiful wife here was about to prepare for a kidney donation. Obviously, what I went through with my father, I felt for him. I was able to make a call to the Mayo Clinic. We really hit it off. But Tom was running a big mortgage company. He wanted to be able to slow down and not create a second job, buy more properties. He already owned a few properties. And he said he wanted to set a goal where by the time his wife was ready for a kidney donation, he could step down and just have time with her. And within a few short years, he had over $1 million in equity with us and almost $12,000 a month in extra cash flow. Tom also, one of the guys who bought a plane. He's a former Air Force. One of his last rentals with us, he says the plane pays his, the last rental property pays for his plane payment that he has. And this was a text that he sent me that really, really made my day on July 1st. We were talking about family. And he said, oh, by the way, I retired from Fairway Mortgage. You played a big part. Thank you for making that happen. We love stories like this. This is what we want for not only ourselves, for Tom, but for you as well. And it all started with this. This was a duplex, about 7 years ago in Southwest Florida. He started one investment and then grew into 4 more and then 2 more. And that's how it starts. It started with 1, and then for Tom, he got aggressive. He went into 3 more and then 4 more after that. And it ended up working very well for him. And he made money. How did he make this money? Well, the 5 ways to make money in real estate. There's 5 ways. Appreciation, leverage, meaning that you buy a $200,000 property, you don't need $200,000. You might only need $40,000. That's the great thing about leverages and mortgages that the stock market doesn't have. Debt pay down, you let the tenant pay down your property. Tax benefits. I'm doing a whole webinar in about 2 weeks about the tax advantages. You might want to check it out. There are so many tax advantages to rental real estate. And then cash flow. Cash flow is key. That's part of passive income. But I do want to say this, between number 1 and number 5, guys, I always look now at number 1 a little bit more and how to set myself up for that. Because going back 25 years, cash flow has been great. But it's number 1, appreciation, that has made the most amount of my wealth. And I will always sacrifice some cash flow now for a better property today. And we'll talk a little bit about that. So let me talk about what not to do. We just showed the 5 ways to make money in real estate, but what are the common pitfalls for real estate investing? Well, let's talk about that. First one is short-term thinking. I mean, this is called long-term buy and hold. You don't necessarily have to be like my Irish family that's holding a property for 142 years, but you can't think in 6 months, 12 months, and 18 months only. Again, that's at that starter level of maybe fixing and flipping, and that can get you somewhere, but you're trading time for dollars and you're left with no assets. And if you're saying, I need to, this has to be, retiring me in the next 12 months, you're really having some short-term thinking, or saying, well, this doesn't provide me enough right now. I'm going to wait a few years. That's very short-term thinking. You have to look for the long term. And if you're only willing to think in the short term, real estate investing is going to be very hard to find success in. Do it yourself. This is a really dangerous thing that I've found for people that are, let's say, where I came from California, being there for years, and came to Florida. When you try to do it yourself, if you're too busy or too far away, this is where I've seen people try to save $1 and get themselves in a lot of trouble. Now, maybe you like to do it yourself, maybe you have the time, then that's great. But if you don't, this is one that I've seen sink people on their first real estate deal. They're far away, they're too busy, they try to get into something, they try to put together their own team that's been untested with no track record, and they can end up really putting themselves in a financial bind, thinking that they were actually doing the grunt work to get a better deal. So not that you can't do this, but it's a pitfall to be careful of. Chasing cheap. I can't stress this enough. If I could go back, I've said this to my oldest sons, sounds so cool. I did these thousands of deals. What would I do differently? I'd do less. I would own less of better quality. Chasing cheap can be very dangerous, and it's very popular out there, especially in the turnkey rental space, where you're offered a very low price property, which shows like it could have a very high cash flow. And how could I go wrong buying this property for $80,000? I can tell you, you can go very wrong chasing cheap. And I went through that. You'll read that in my book. Some of you, if you've read the book, the struggles that I went through that could have bankrupted me chasing cheap instead of quality properties. I would rather own less of better quality. That's what I do today. And I have more equity and more cash flow than when I had tons of cheap properties. And so this is something that you want to be careful of, chasing cheap. Misdirected charity. Your rental properties are not for charity. Now, this is something that I talk about in my early days. My first rentals, I took more stories from the tenants than I did actual rent checks. And that was very dangerous. Again, that could have bankrupted me with my first 5 rentals. And I learned that if I'm going to give to charities that I care about, and I give to several different charities, then I need to make sure I keep my rental properties and my and my charity separate. Because if I give charity my rental properties, I can't give anywhere else. So this is why I like to have a property manager in the middle, so there's less emotion involved, fairness, but less emotion. And you want to take this one to heart. You're buying this as an investment, not as a charity. They're both great, but keep them separate. You don't want to misdirect this to charity. Wrong partners. I mean, this is probably anything in life, whether it's the marriage, whether it's a business you're going into. going into the wrong partnerships can be really detrimental. So you want to make sure you have the right partners. We're seeing this right now. Unfortunately, there were some builders that got in over their heads, and we've been trying to rescue some investors in different areas of Florida where the builders have gone belly up with projects half done. You want to have the right partners. You want to make sure they've been seasoned, they've been tested, that you've, done a background check on them, all these things. Doing that, you're going to be able to avoid the wrong partners. But who you're partnering with, whatever you're doing, but especially real estate investing and turnkey real estate investing, is absolutely crucial. You want to avoid the wrong partners. So what's our plan for 2025? Well, I already told you, this is 2025 and really beyond. It's what it's always been, and we're sticking to it. Affordable new construction. We don't do any fixer-uppers anymore. In affordable growth markets, it has those 5 factors that we talked about, with low interest mortgage financing. I'm going to talk more about that to help ensure cash flow. You got to have these things. And if you have great management in place, then this is our plan to achieve wealth for not only our company, but for our investors as well. So savvy investors use proven system strategies and guidance to make money in real estate by producing repeatable results. Guys, we do the same thing over and over and over. I remember my first mentor saying, Jim, making money in real estate should be boring. You should be able to say it in one sentence. If you want excitement, go jump out of an airplane, go diving with sharks, go surfing, but not with your real estate. Do the same thing over and over so you get better and better and better at it. And that's what I think we've done with our new construction turnkey model. Again, there's only 3 parts to what we do, but they're very important. The first thing is we got to build it right for you. Building it right is getting the right land in the right areas with the right materials to today's standards, which we'll talk about a little bit, hurricane resistance, all sorts of things with the right upgrades within the home to get the best rentability and resaleability. We got to build it right for you. Second thing we got to do is finance it right for you. We're going to talk about that. And that's not only with mortgages. And I'm sure a lot of you have heard, oh, you can't get cheap mortgages, not for the last few years. Not true, not with the mortgage program we have. And also you'll hear the rumors, well, you can't get insurance in Florida anymore, or insurance is so expensive in Florida. Also not right. Our job is to find great insurance for you and get it financed right for you. We've been able to do that and then manage it right. Again, you're probably busy. I do not like managing my own properties. I don't manage my own properties. You got to have someone there to manage it right, and we provide that as well. Now, let's talk a little bit more about the mortgage financing, because a lot of people don't seem to grasp what it is. So as a builder with a very healthy balance sheet, banks are willing to work with us on what's called a builder forward commitment. We can only get this on our new construction properties, but what we do actually is we're now in the money buying business. We go in with 2 banks we work with, and we buy large tranches of money for mortgages that we pass along to our investors that they're able to use for their mortgage money to finance one of our homes. And we pay a premium up front to be able to get lower rates than are available right now. Well, our most popular mortgage plan right now is a 3.75, which is a 30-year AM and 10-year fixed, 3.75. So we're beating the average. If you went into one of the big banks right now for one of our duplexes, they'd probably quote you a rate of 7.25. We're beating that by 3+%. Or if you're a little more conservative, you want a 30-year AM, 30-year fixed mortgage, that's fine. You can do 4.25% for you. And that's, a way that we're able to get you instant cash flow. Also, we give the first 2 years of management free on any of our new construction, because we want you to stay long-term. We have about a 95% retention rate on our management. The first 2 years are free. By doing this is how we get that instant cash flow, that cash flow up front, and how we're beating the markets. People, again, say there's no way you can get those mortgages. Again, talk to our property counselors more. This is one of the best parts about our program, because a lot of builders don't have the financial balance sheet to qualify. We're in a very blessed position to be able to do that. Again, economic growth, population growth, affordability, that's the key word, right? With desirability and healthy supply and demand, this is where we're building our recipe of houses, guys. I cannot stress that enough. So let's look at a couple of things, the markets that we're in. Okay, this right here is a Fed chart from the Federal Reserve, and it shows, I love the Southeast, but we are not currently building in Alabama, nor do we plan to. Now, why? Well, one of the things that I was taught was population can really cover your tracks of concerns. And what does that mean? Well, if you got a big group of population consistently coming to an area, it's great for jobs. It's great for values, and especially real estate values. So when you look at this, the red line going like a hockey stick, that's the growth of Florida since the early 1900s. And the blue line, that's Alabama. Again, great area, beautiful spots, but I like to have a little more population growth wind at my back. And that's why we grow in Florida. This is something that we look for and that we really capitalize on. Also, that affordability word. Something interesting happened. You're hearing, oh, I heard there's problems in Florida. And we'll talk a little bit more about that. Certain areas, certain higher end properties have seen a reduction, but we like to stick to that workforce housing, that affordable housing. Here's why. The Sunshine State right now has only 25 affordable rental homes, those workforce housing rental homes, only 25 available for every 100 low-income renters. Think about that. Think about that number. Every 25 rental homes available in that workforce affordable housing range has 100 low-income renters needing property. That's why we stick to that affordability zone, and we want to continue to capitalize on it. Overall, too, something to hear about, because there's all sorts of sky is falling right now. The U.S. today is still short 4.5 million homes for existing people. And that'll vary from area to area. Again, Florida, Southeast is a big part of that, but that's across the USA. We still have a major housing shortage. One of the reasons that I love real estate. Supply and demand too. We really ran into an issue with not only the supply chains, which slowed down needed housing, especially here in Florida, but when interest rates started to jump in June of 2022, we saw a lot of builders starting to go onto the sidelines, and permit issuing, which is a number we watch very closely, really took a peak in about the beginning of 2023 and then dropped. Now, when it peaked, it takes about, and I know this might be a little confusing, your property counselor can go through it more, so stay with me, but it peaked at about the beginning of 2023, and it takes about 2 years to work through until you start to see a shortage in properties. So what we're seeing right now is that a lot of what we call COVID inventory came on the market about the beginning of last year. And that made a slowdown. Properties were going from 30 days average fill time to 65 days. Now we're starting to see that contract down again. And we're expecting, and we can't promise that, but based on the supply and demand permitting issues and lack that we're seeing, that we believe there's going to be another inventory shortage by the end of 2025, following the supply and demand of permits issued, especially in the workforce housing. So this is something we tell people to look for. Not only that, but tariffs. If you're concerned about tariffs starting to increase building supplies again, and something we're watching, then we encourage you to buy a home sometime very soon. Because if that's the case, that means your existing home is already going to go up in value based on just those tariffs increasing the expenses just to get a new home built, if that makes sense. So this is something you really want to start to study. Supply and demand too. Let's talk about this. A lot of things you hear going through the pandemic, Florida markets had the lowest amount of inventory they've ever had in history, ever. And we had about 2 weeks or 3 weeks of inventory on the multiple listing service. A healthy market will normally have about 5 months of inventory, real estate inventory available. In going into 07, 08, right at the meltdown, it was about 16 months of inventory, which tells you why there was that real estate crash along with some bad financing in 2007, 2008. But looking at today's number of listings, let's look at this. December of 2019, this is before the pandemic, by everyone's measurements was a very normal real estate market. There was some increases going on. There was a steadiness. Rents were well aligned with values at that median. And the number of listings was at a healthy level. It was just over 20,000 in that time. So what we've been hearing now is, oh my gosh, inventory levels are so much higher in Florida now. Well, that would be true if you were comparing it from 2021, where they were at the lowest they had ever been. It was a very, very insane market at that time. But compared to December of 2019 to December of 2024, just a few months ago, the inventories were only a little bit higher. They're about 2,000 higher for this Northeast Florida area. This is Northeast Florida. And that's just about the same because everyone knows we had a ton of population growth through those 5 years. So if you're concerned about inventory levels, we get that. What about inventory levels? I heard inventory levels are so much higher. I tell them to dissect it a little bit more. We are just about at the same level as 2019 as we are now. That tells me we're still at healthy levels, especially sticking to the affordable medium part of the market. So we feel really good about that. Again, time in the market is most important versus timing the market. But let me go a little bit deeper. Can you do both? Are there signs to do both, to have long time in the market, but then also time the market when there could be opportunities? Absolutely. So prosperity in the age of decline, the Brian Belay and his brother Alan, I've been following these guys for years. They have a 94% accuracy since the early 80s. They're the ones who really helped forge me in this direction of workforce housing and the new construction model and the type of areas we build in. They have a group called ITR Economics. I've been a member for years, highly recommend it. And I follow their stuff every month. They do all the industries, not just housing, but all the industries. And let me show you something of last month. So I've been following their scales for I don't know how many years now, but there's 3 phases to industries. There's recession, slowing growth, accelerating growth, and recovery. And they do it for everything: non-residential construction, medical, consumer prices, retail, foreign, financial, wholesale, trade, production. You might be in some of these businesses. I highly recommend you checking them out. Again, I've just really, really appreciated their content. It's been so helpful. Let's look, though, at the very bottom of a hard landing right there. What's there at the middle bottom as of last month? Housing. Housing is, why is that? Because the interest rates just took way bigger a climb than we thought. That interest rates took climb. Then there was also problems with more houses having been built. Tons of things were delayed. Builders couldn't get financing. So housing has shown to have a light recession. Again, most of that brunt has been felt in the higher end markets, and the workforce housing is stated about equal value. However, they are seeing now what's coming up next after a hard landing: a recovery and accelerated growth. So if you look where housing is, you always want to buy at the bottom and on the rise up. We are feeling very strongly about what is about to happen in our Florida markets for the next 4 to 5 years. Again, not our words, but the people we hire, not only ITR, but James Burns. Some of you have read the reports of the markets we focus in. So if you are really looking to time the market, this is not my write-up. This is ITR's. Look where housing is. Look where you could be going into. And the fundamentals are very sound of why we've gotten to this point, but also why we have a very nice upward swing looking for at least the next 4 to 5 years. So once again, guys, I know I repeat myself, but that's for good reason. Affordable new construction, affordable growth markets, low interest mortgage financing that helps ensure cash flow with great management in place. So let's look at a couple of sample properties. Okay, this is, again, the bedrock of the U.S. economy, the single-family home. Here's Ocala. This was picked our #1 market to watch for 2025 because of its affordability, the growth that's occurring there, the lifestyle. Still getting houses here, a nice 3-bedroom, 2-bath property for under $280,000, new construction. You know, and you look with our mortgage program, taxes, insurance. Again, let me look at that insurance number real quick. $64 a month. That's full insurance. Again, some of you are going, wait a minute, I thought it'd be $640 a month from what I had heard of you couldn't get property insurance in Florida. Again, not true, especially with new construction, and depending the area you are, these are accurate quotes from our insurance provider. And we do not charge property management for the first 2 years. That monthly fee is waived. So based off of monthly expenses and monthly income, you should be starting at a cash flow of over $330 and a 5-year hold estimated profit of $138,972, based off very conservative numbers that we follow, that I've followed for at least 25 years with my own rentals, and our property counselors will dissect exactly how we go through this. But this is a classic starter property for someone just getting involved or someone who wants to test the waters. Ocala is our most affordable market with a lot of growth, so it's the cheapest buy-in with the fastest rentals. Again, a great starter property, but this gives you an idea of what is actual purchase price. You know, what does insurance cost? What does taxes cost? What will my mortgage cost? What's the cash flow that I can expect? If I hold this property for 5 years based off conservative numbers, what might I get? This is a good sample of that. Now, a duplex. I love duplexes. Again, some of you have seen me speak already. The duplex just has the best of both worlds. It can be put in a great single family home neighborhood with a lot of pride of ownership, but it can get you 2 tenants under one roof and up your cash flow significantly with one loan in place. And again, we've just released more Ocala duplexes. We were sold out of them for a few years, and we're just going back into some completed ones. Again, you're getting 2 properties under one roof, 2 units under one roof for less than $400,000. And after taxes and insurance, you'll see the insurance again at $92, full insurance. You're looking at almost $600 cash flow to start, and a 5-year hold of over $200,000. Again, time in the market, right? Time in the market. And that cash flow is off of today. Jennifer's watching this. She had people that started buying with us, Ocala years ago. That cash flow has more than doubled over the last 7 to 8 years. Don't promise that, but again, with conservative numbers, if things continue, that cash flow should increase, which again, I like cash flow, but the appreciation in these types of markets to watch is what I look for. Now, the most successful investors in our networking community own about 3 to 8 properties with us. And we have people that go to 10, 12, 15. We've had a person buy 28 properties. And we work with some of the larger groups that buy more than that. But when you look at, well, what does this take to actually start to have a residual income, something to lean on in retirement, or, in case something happened to my job or me? Our most successful investors that work with us own about 3 to 8 properties, a combination of single family duplexes and quads. They usually put together that strategy with their property counselor. And we found this is a sweet spot where people can build something up that starts to really feed back to them and create some more net worth because of the equity created in the properties. So if you're thinking, gosh, I got to have, I talk about that. I was up to about 200 rentals. You don't need that. And again, a lot of my rentals were losing money. I'd rather have a solid 3 to 8 better quality, higher quality properties that could produce your goals of cash flow and equity growth. And so that's what we do. So no, you don't have to go to such extremes. This is where a lot of our sweet spot lies with our most successful investors. Adam's one of our most successful investors. He owns some properties in Utah. He came out here really interested, became family friends. Our wives hit it off. And he was really shy about letting go because he had always done the properties himself in his own backyard of Salt Lake, but the numbers didn't work anymore. But he liked the new construction a lot. He went into his first 2 properties, and then he jumped into about 4 more. Adam went to another level and went to about 5 more, and then even started to do a few deals here in the local area from people I introduced him to. And he went up to over $20,000 in estimated monthly cash flow just from making some conscious decision to start investing from Salt Lake City, Utah to here. And it's created about $3 million in additional equity in 4 years. He's enjoying a lot of time with his family. I saw him on visit here a few weeks ago. And it's great to see these stories again. So he took it a little bit larger than the 3 to 8, but if he had just stuck to his first 8 properties, he would have probably been about halfway to this point. So asset owners win, guys. Job security loses. Job security loses on its own. It's true. You have to have a savings plan to get into your own assets and look long-term. That's a winning formula. It was winning for me. That's where I started in job security, but I saved and I would invest into my properties, and owning assets can help you win. And that's what we want to see you do, is be able to win. So not everyone's going to be as far as Tom or Adam, but let's look at this one from one of our new investors with our White Coat community. There's probably a few people from White Coat. We were just out with you guys in Texas, had a great time. Working with SI Homes has been incredible. Austin guided me on what to be the most profitable investment in my portfolio, always working diligently to get the best deal. The entire team at Suncoast Property Management has been outstanding. Nicole, Stacy, Kelly, and Lindsay have done an amazing job from quickly filling vacancies to ensuring my property is well managed. I was so impressed that I've now hired them to manage my other properties as well. And I'm currently in negotiations on my second build-to-rent property with SI Homes and plan to continue growing. This is exactly what we want. So he's a little bit more early in the journey, but this is what we have to do. We want to make your first deal or first 2 deals go right, so you go to your second, third, or fourth, or fifth. That's how it works. We want to earn your trust, earn your profits, let you see the results, and then continue to grow with you. And this is, again, the goal over and over with the same type of property, the same type of systems, the same insurance, the same mortgages over and over and over. We stay in our lane, we stay close to the median, It's worked, and we want to make sure we mitigate risk while increasing profits and gains as much as we possibly can. So Dr. Amina Goodwin, again, one of our investors, same thing, a little more in the mid journey, about 6,000 in monthly cash flow, almost $1 million in equity growth as well. So why join our investor community? Well, it's going to give you access to our educational videos and market updates. Some of you are probably sick of seeing me on videos. Others are saying, no, keep doing them. But this is one of the best ways we can teach. We do send out 2 emails a week that will have our hot pick property along with market updates and normally new videos of me talking about anything from the possibility that Governor DeSantis might waive property taxes here, or what is the Fed doing with interest rates over the next 6 months, and how will that affect the building market? Just things if you're really wanting to learn, what are the new landlord laws saying for Florida on a squatter? It could be anything of interest if you're going to get into that. And hopefully you work with us, but either way, you'll be able to take it with knowledge wherever you are. And it's a done-for-you program, guys, with one-on-one coaching. You know, what worked for Tom maybe wouldn't have worked for Adam or worked for Amina, but the one-on-one coaching with your property counselor, there's no charge for an obligation. They've done this so many times, they can get you a tailored program to build your own portfolio, okay? And they hold your hand and educate through the entire process, so you're involved but never alone. And again, what's the goal? Build right, finance right, manage right. That's what we do for you. And we've also, have ongoing coaching and support systems whenever you need it. Our cares department, or your portfolio manager. Again, you'll be able to go through this whole flow chart of what it looks like to be with us for the first 5 years with your property counselor. And we want to support you longer than that. I know that, some of our counselors like Jennifer, who's on here, she's having conversations with people that bought with her 17 years ago and are buying another property this month. We want to stay with you for the long term and be here to actually see the best results. So what are the next steps? The next steps, go to Southern Impression Homes and request a call. If you haven't had a call with your property counselor to have a free dissect, please do that. It's so important to do that discovery call, get that done, talk to the property counselor, and that's the future step. That's how you can start to be on the road to passive income and active freedom. So good. I want to make sure I take a few minutes to answer some questions for the next 10 to 15 minutes. Jen, do we have some questions that we want to go through?
We do. Hang on one second. So one question is from Karen, and you talked about it a little bit, but she just wanted to know, what's the discussion on the concerns about the declining property values in Florida that are significant?
Sure. So as I talked about, and I'm sorry, what was her name, Jen?
Karen.
Karen, great question. So one thing that I always say about Florida too, there are 29 million people here. So we have almost the same amount of people as Canada or Australia. So we are third largest, I think, behind Texas and California. There are a lot of different markets within Florida. So when you start to hear about these declining values, what I've said, again, we're not in Miami, we're not in Orlando, we're not in Tampa. These areas being the most popular, growing up in New Jersey, I thought those were the only spots in Florida. These are the areas that had the most amount of growth, the most amount of equity growth. So they were so overinflated that they have had some settling back down, which was natural. They're still way ahead of what they were, but they've had some settling back down. Also, in lots of areas of Florida, close to the coast areas, very close to the coast, high hurricane risk zones, where it's older properties, those have had decline because the insurance rates have gone up on those types of properties. We, again, stick to the affordable median price. So affordability index is very important. What I can explain is that means what is the average family income for an area compared to the average median home price. And I always work through that number to see whether an area is healthy or not. So like you go to San Francisco, California, or Orange County, California, very unhealthy number. Manhattan, New York, very unhealthy. Ocala, Florida, extremely healthy affordability index. You saw properties are still under 300,000, and the average family income in Ocala is about 72,000. That's a really good number to make sure people can afford a house to either buy it or rent it. So we are sticking to an area, again, where they say it's hard to fall off the floor. And I don't even like to call it the floor. We're building probably the most affordable new construction that people can get. But again, I'm not going to the bottom of the barrel in our area because those areas have a lot of turnover, a lot of maintenance and repairs, a lot of problems. I don't go there anymore. So there are corrections that have occurred in Florida, very close to the coast, low-lying, old construction properties that were not built to today's standards. The insurance has gone up, so their values have gone down. Also, areas where that were the most popular in higher-end type properties, those have really been the ones we've seen come down. Our median values on these cheaper properties that we build and focus on have stayed consistent. And that's through these last 2 years of these interest rates. So we feel now, again, going into an inventory shortage, not right now, but 6 months, 10 months, 12 months from now, we think there's going to be an inventory shortage, which will help values increase and rents increase again. So please make sure you dissect it. There are lots of different markets within the Florida markets. We avoid the high end, and we're also not in those areas that had the most amount of, really unsustained growth where it naturally knew there was going to be some fall coming from that. So hopefully that answers that.
Okay, I've got one from Colleen. She was asking, is it better on your first investment to put the property in a Florida trust? What would be the pros and cons in doing that? And would it affect the refi if a refinance was needed? Like if she went to refi, having it in the trust, would it make a difference?
Um, I am not an attorney or an accountant, so it's tough for me to say on the trust. I've worked a little bit. All I can talk about here is personal experience. I've worked a little bit in family trusts and land trusts. Me personally, I have a very simple system for buying a property. I will buy a property, qualify in my name, close on it. And then after closing, I will deed it into an LLC owned by my wife and I, because I don't want a single member LLC because that's easier to penetrate. So my wife and I own it, and for estate planning and tax purposes. And that's how I hold my properties. I don't, some people hold one per LLC. Again, I can only talk about me personally. I think that's very expensive for taxes and accounting. So a lot of people I know keep a few properties at least in an LLC. And then if, a couple years down the road, you run a refinance, well, then there's different banks that will allow it to be refied in the LLC since you already own the property. Or you might have to just have it deeded back out of your name to qualify. And then once it goes back in. So I've done it both ways. We're like, no, you've owned it for years. It's seasoned. We'll refi you, no problem. Or no, we need to see it in your name. So my title company will deed it back into my name. They'll qualify me. And then after closing, again, it's my right for tax planning and estate purposes to put it into one of the LLCs. So I've always used LLCs. And that's the way I do it. I don't usually, when I first buy a property, ever use an LLC to buy it. Why? Because banks don't like that. They like me. They want me on the hook. And I get a way better rate and way better terms. So I always take advantage of that, and then I deed it into the LLC. So again,
I was gonna say with our preferred lender, CMG, you can close the property in your personal name, or you can close it in a trust and you still can take advantage of the conventional financing. And then you could later, if you wanted, put it in an LLC at
yeah,
that point. Most
yeah,
of our investors will handle it that way.
yeah. So there's both choices. Again, me personally, I haven't done a lot of trusts, but our lender accepts them. So again, it's a great option for you to do it. And again, one thing, I don't encourage you to own property in your own name. It is good to have a level of protection. I do want to remind people though, that you do have a good insurance policy in place, no matter what. And so slip and falls and such, talk to our insurance provider, but you have usually a few $1,000s worth of coverage to protect you. So yes, entity structuring is super important, but remember one of the other most important things, you are going to have insurance that gives you protection and, God forbid something happens, payout protection, on a classic slip and fall. I can tell you of hundreds of my own personal rentals, I've had 2 slip and falls that were very minimal. So consider me lucky, but that's what I've had, and insurance took care of them.
Okay. I don't have another question in the Q&A, but I put a little snippet about DeSantis potentially getting rid of property taxes.
Yeah.
Would there be, I know one question would be, what would be the benefit of that? And
Well, Great question. So we got to make up about $40 billion if they're going to get rid of a lot of the and this is residential real estate tax. So this doesn't mean all the big commercial buildings and other things aren't going to have property taxes. They're talking more about residential real estate, which is great. That's all we build. So our properties would all, technically be, available to get this. I think it's a great thing, especially if you're out of area. Most of that they're saying would be consumed up in sales tax. So there's going to be sales tax and other things to make up for that. So if you're not really here spending, then it's going to fall on me and Jennifer and Jaden more, which I'm okay with because I can spread out, I think, in different ways. And I think it's a great thing, especially for cash flow. I mean, you look at one of our duplexes, that could add an additional $400 a month to your cash flow right off the bat. I mean, that's extremely exciting. I think that, there's already people looking at this very seriously saying, wow, this is bigger investors as well. You're getting rid of property tax on residential real estate. I know what that does to my returns then. I mean, you can look, property taxes go away, or even if they're cut in half, that could up your actual ROI quite significantly. And again, for out of area people, if you're investing with us from out of area, it's really not going to fall on you very much at all because you're not here actively spending and with a sales tax that would hit you.
Okay. I answered this one question, but Colleen had asked about sinkholes, if that was covered on insurance, which it is. I've confirmed that with Chris Salome, with Leland Insurance, our preferred insurance agent, and I know sinkhole coverage is covered as well as hurricane as part of your homeowner's insurance.
Great. And I had a couple questions come in last month that I'm going to re-answer. Insurance and hurricanes. Everyone wants to know about the H word again. I was a Jersey boy that lived in California for years, so I got used to earthquakes, but then I came here and didn't know anything about hurricanes. Look, hurricanes, again, there are certain areas that we don't build in. The Florida Keys, southeast Florida on the East Coast is the highest hurricane risk zone. So we're not building there. Those are the highest risk zones, but we are in risk zones like in Southwest Florida. However, like the last two large hurricanes that went through there, we had hundreds of projects on the ground and had very minimal damage and no flooding. Why is that? Well, because when you build a new construction property, this is very important for all of you to know. When you build a new construction property, it's very different. The rules changed in 2004 after a large hurricane hit Punta Gorda, Florida, where we build now. It was decimated. We had a relative living there, but it was rebuilt on different standards, different structural design and higher ground. So, back in the day in the 1950s, you could build a house at 2 feet above sea level. Today, you have to build it at 13, 14 feet above sea level. So we got to bring in a lot of dirt to make it work right. And that gives you a level of safety. And not only does that help give you peace of mind, but it gives your insurance company peace of mind. And Chris, again, at Leland always has these conversations where they're all about assessing risk. So that's why when you say, why are your insurance rates so low? Like even in those areas, Punta Gorda, we insure there for a very nominal fee. Our insurance company does that we work with. Well, it's because they look at risk analysis. Our new construction properties are built with stronger structural design, stronger fasteners, and at much higher ground. So we've performed very well through storms that have come through there because of that. So there's a huge difference between that new construction property compared to an old construction property, built many years ago on low-lying ground. Also, even though we're in coastal communities, we're still usually building a few miles inland. And once you go a few miles inland, again, your insurance takes that risk analysis because the risk for them goes down. I live on a small barrier island here, only 10 houses wide. My house was built in 04 though, so it's in high ground, so I don't have ridiculous premiums, but I take a bigger risk living on this small barrier island 50 feet off the ocean. But most of my properties are a little further inland, if that makes sense. So their insurance is even cheaper. So again, if someone gives you that, I heard you can't get insurance in Florida, I heard insurance is very expensive in Florida, I always like to follow up that question with which property are you talking about? Because every property is assessed differently. And again, that's why we like new construction, because we know we're going to get the best premiums possible. And there's good reason why.
Okay, I've got a financing question here. It says, I see that you offer lower interest rates, but we have to pay for the points. Then where's the difference between what you offer and what other companies are offering if at the end of the day, we have to pay for the reduction of that interest rate.
Okay, yeah, so there are different options, and this is why you want to go over your property counselors. If you don't want to pay any discount points yourself, well, first of all, let me just make this clear. We pay the high majority of the required discount points, they're called, to buy down the rate. So if you were to try to, let's say, get the 4.25% rate right now, let's say you went into your own bank, your own mortgage company, and say, hey, I want to buy down this 30-year mortgage to 4.25%. They would probably tell you that you need to pay them about, they wouldn't even let you do it, first of all, because they don't go that low to just a private investor. But they would say it would probably be between 12 and 16 points, 12 to 16 points to get that rate. So when you look at that right now, you are only paying a few discount points. We're not having to get charged that much, but we're getting charged quite a lot to get these lower rates for you, and we're passing that on to you, with the exception of you putting in some of the discount points. However, if you say, I just don't want to pay any discount points, I just want to, or I'm only willing to pay one discount point, that's it. Well, that's great. Jennifer or any of our other property counselors will show you our options on that. Maybe we're not 3 or 3.5% below your bank, but we're going to be 2.5% the rate below, the rate that you're getting. So we are still coming in much lower. If you're like, I don't want to pay any discount points at all, great. There's options like that, and we're going to come in lower than any other bank is right now.
Okay. The only other question I have, just one was just saying they have 40,000. How can they invest? And that's really our last question that I have on here. Which they could do that if they were doing house hacking, because they could put a much lower percentage rate down, or I'm sorry, down payment
Yeah, so
with
the only way
40,000.
the only way that you could start with 40,000 is house hacking. If you're local, and we've had a few
Mhm.
people do this in one of our markets here, and let's say you're going to, buy a duplex where you only have to put 5% down if you're going to live in one side and rent the other side. That can be a way. I know Jennifer's had some clients even buy quads and live in one unit and rent the other three. So
Mhm.
the one way that you could do it is you could follow the house hacking model. If you're living in one of our markets, you're going to move to one of our markets, you could live in one unit, rent the other. That's definitely a way that you could get started. Or what I encourage too is, if you're at 40, keep working hard to save, and you could set a plan to get into one of your first properties in a year and a half, which might seem really far away, but we're not going anywhere. And again, I believe in owning less of better quality. I'd rather see you keep saving and get a better quality property with us or someone else than go into a more enticing property, but a cheap one that might get you into trouble. And I've seen that happen a lot. Jennifer's seen that happen a lot as well.
Mhm.
So house hacking or keep saving.
Or
One of
do
the
the single family, you could do 20% down, but you would need about 60,
yeah,
62 to do that.
so you're getting closer, getting close.
Mhm.
Good. Well, listen, there are no bad questions, guys. We always appreciate them. Please reach out if something comes up that you didn't remember here. Don't be shy to ask. We'd love to. Also, if you would like a free copy of the Passive Income Playbook, again, best-selling book, it's I think $22.95 at Barnes & Nobles. We'll send it to you for free. It's really some excellent guideposts to your investing journey. We share very openly the good, the bad, and the ugly that I've gone through and others have gone through, and why we do what we do now. Make sure that you write in the chat box your email. Jaden will reach out to you. We'll get your address and we'll send you out that free copy. Again, this is something that I encourage everyone to do. You might get through this and say, owning rental property is not for me. Or you might say, wow, now it makes sense. I feel like I have some working knowledge and a clear map. And either way, you're gonna gain something. So, highly encourage that. Set a call with your property counselor. There is no obligation. They're just going to go through something that they've done a ton of times to help people succeed. We may be a fit for you, we may not, but at least you can take those next steps to find out what we could do. You can also get an idea of where you stand financially. Getting pre-qualified by a really good investor lender can be a great thing whether you're ready or not. So I encourage you to look at that. There's no fee for that. And you might be surprised at how well qualified you actually be. So many people come to us, I don't know if I'd be able to qualify for something, and they find out just the opposite. So that's always a nice thing to know. I remember the first time I qualified, I thought there's no way someone's giving me money from a bank. But I was able to qualify for more than I actually knew. So anyway, something to look at. Again, great starting point tonight. Hopefully you learned a few things, the solid principles, the journey, time in the market, guys. Remember that. And you don't have to complicate things. You can do the same simple thing over and over and over to buy back your time, create that passive income for active freedom. We'd love to help you do it. So, on behalf of our whole team, thanks for coming tonight. Please stay in touch. If you are looking to learn more about tax strategies, join us on our next webinar, which will be in about 2 weeks. We're going to dig deep into that and show you some things that really can help accelerate your wealth. So again, thanks for coming, Jen. Thanks for the great handling of all the questions, and we will talk to everyone soon.
All righty.
Have a good night, everyone. Thanks for joining us.